Hello everyone, I'm Peter Towers, Managing Director of ESS BIZTOOLS, and this presentation is the ESS BIZTOOLS Business Advisory Services Need to Know series. And today I'm joined by Paul Barnaby, the Australasian representative for Plan Guru and the Managing Director of Beyond Accounting Technologies. How are you, Paul?
I'm indeed well, Peter. Thank you very much.
That's good. Today we're going to talk about predictive accounting and what its implications, but would you mind going back to the beginning? We've had budgets and cash flows as being part of the structure of most accounting firms for the last 30 to 40 years, and in some cases probably 100 years. But what's the difference between that profit and loss account and cash flow forecast and what is covered by predictive accounting?
Yeah, good question, Peter. And perhaps I'll illustrate that with an example. Going back a long time, I was asked to prepare budgets for a key client of mine who was an importer, wholesaler, and in fact exporter. So quite a complicated company.
Yeah.
And the bank wanted some budgets. So I put together a profit and loss budget for the next 2 or 3 years. But the bank manager concerned was quite astute because he rang me up independently of the client and said, Paul, great budget, thank you very much, but where's the balance sheet and the cash flow?
Ah, good question, good banker.
So my stomach turned 3 times and I thought, how the hell am I going to do that? So somehow I struggled by, Peter, but it taught me a very valuable lesson. That lesson is that just a profit and loss budget is hopelessly insufficient because it's only half or less than half of the story. And what we've got to do is look at a set of strategies and what is their impact on the balance sheet, as well as the profit and loss account, and therefore the cash flow. And so that's why I use the term predictive accounting.
Yeah, a very good term. So what are the key, there's this concept of key drivers included within predictive accounting. What do what's included in key drivers? Okay.
Again, I'll use that same example, which would probably go back 30 odd years. When I first learned budgeting, my mentors said, well, what you do a budget is you look at last year and you add or subtract a bit for next year, and that's the budget.
Yeah.
At the time, I remember thinking, well, okay, that's fine. But what if you don't achieve the budget? What if when you do your reviews, that dollar budget wasn't achieved, or it might have been overachieved? So what went wrong? And that was what started my passion now for predictive accounting, which is nothing more or less than doing for future accounting periods what we're all trained to do for historic accounting periods. Capture the proposed transactions and put them into a future set of financial statements, including cash flow. So the components of that, if we're going to move away from just dollars, we might have a startup. So if we've got a startup, we've got no budget, we've got no history, we're forced to look at what is going to drive those financial statements. Is it the product or service that this company or organisation is providing? Is it the quantity that they're thinking they're going to provide of sale of services or products? And that goes on into a line-by-line analysis of those key financial statements. Because unless you look at a key driver, some of them may not have a driver. If you've got general expenses of less than 5,000 per year, you probably wouldn't look at what drives that. But if you've got wages and salaries, you bet. Who are we employing? If we drive sales up, do we need to employ somebody else? Yeah, those are the drivers. So the quantities, the price, the investment. What about the inventory? So almost every line that you look at in your budgets are going to have a key driver of one shape.
So really what it's requiring us to do is to completely analyze the key drivers, as you say, the number of employees, the wages they're going to be paid, the on costs that apply, the electricity, the purchase of materials. Need to look at all that before anyone even thinks about looking at a budget.
Absolutely right. And I guess in defence, if I can, of my own profession, that can create a difficult task.
Hey, I'm part of that profession too.
Yes. So how do you translate that to the financial statements?
Yeah.
But that is the key to it, Peter. If you find the appropriate driver, you then apply that and translate it into revenue or cost or balance sheet, whatever the case may be. And it's that link that is vitally important.
Yes, and the other thing you mentioned in all that, in your story of 30 years ago, was the request from a bank manager. Now, he was obviously an astute bank manager, but it shouldn't be the bank managers that are driving the requirements for companies or businesses to have some idea of what the impact of the decisions they're making today might look like in 3 or 4 years' time, is it?
No, exactly right. And yes, that was a very astute bank manager. He went on to become country manager of that particular bank. So he was a very switched on fellow. And very few people 30 years ago were in fact preparing budgets in the public accounting profession. Because
That's right.
then, with now, there was always the preoccupation with compliance and tax, and advisory work sort of became a poor cousin. Not in my practice, when I eventually re-engineered it, but for most practices, yes, it was sort of a poor cousin.
And I'm recalling, as we're talking, my experience in a public company that had been on the then Sydney Stock Exchange for nearly 50 years when I became the Chief Financial Officer. And I am a bit ashamed to say again, it was the bank request. The bank said, I think we should get a budget. And my CEO came to me and said, well, what's a budget? What are you going to put into a budget? The bank wants a budget. And that was the first time that public company, listed public company, had been asked to prepare a budget. Well, there was no computers. I'm going back a few years, quite a long way, actually. Myself and a very gifted clerical person, he wasn't an accountant, but he probably knew more than what accountants did, to be honest, sat down for about 3 weeks. And we did go back to key drivers. You might be very impressed with, Paul, because that's where we had to start, because we had really no basis and we were in the meat industry. So we were doing all sorts of things with animals that we were slaughtering for meat. And the planning of that was an unbelievable exercise. But as we've been talking, and as I've encompassed this whole concept of the 3-in-1 forecast approach with having a projected balance sheet, I've realized a few times over the years that we never did a projected balance sheet on that huge exercise we did. And I hope it did balance, but maybe it didn't, but it served the purpose at the time. The bank got their budget. But I don't think that's what we're recommending in 2021, are we? This should be something that's driven internally by accountants talking to their clients and saying, as part of the process, we should be undertaking predictive accounting so that you and your leadership team can sit down, you can help us identify these key drivers, and we're then going to show you how we're putting that into these futuristic forecasts so you can see the results. Is that how you see it?
Yeah, absolutely right. In fact, my recommendation to advisory practices is that predictive accounting is a compulsory part of the service. This is what we do. We do predictive accounting. We work with you. But more importantly, and again, I look at my experience talking to other accountants, And as recently as a few weeks ago, I said to an accounting practice, do you prepare budgets for your clients? Oh, yeah, sure, we do. Under what circumstances do you prepare them? Oh, when the bank asks for them. And I said, so no other time? Well, no, not generally. And I went on and I said, and when you prepared the budget for the bank, what happens after that? And the question was, what do you mean? Well, do you review progress against the budget? No. Well, don't you think you should? Because that's the process. Peter, what might be helpful, I've got a couple of slides and an example.
Oh, yeah, that'd be great. Yeah.
Of what drivers are all about and how it translates to those financial statements.
Yeah,
so
let's have a look at it, Paul.
My screen. Let's have a look, and I'll show you what I'm talking about. Okay.
Yeah, I can see you. Yeah, your screen's on there now.
Okay. So just back on the methodologies, because over the years there have been various methodologies proposed by the finance industry generally. And we've been talking about traditional budgeting, which takes last year and adds a bit. And so you already know my views on that, because the historic accounts may have absolutely nothing to do with what's coming up next year. And after we moved from traditional budgeting, there was a thing called zero-based budgeting. And
yeah, that's right.
I grappled with that for a while. And what that does, it's somewhere towards the key driver, but it just says you're starting from a zero position. And that's what you did at your meat company, I think. You started from a zero position. And that, yes, extraordinarily time-consuming, extraordinarily complicated. It won't be news to you that obviously my key driver budgeting preference is because of what we've just been talking about.
Yeah,
you need to do a line-by-line analysis. For example, sales quantities, investment in inventory, receivables, payables, fixed assets. This is the only, in my view, option when it comes to proper predictive accounting. And what I just wanted to share with you was, what if you were posed this question by a client? They're going to sell widgets. They're going to be ready on the 1st of July. Their widget is going to have a selling price of $50. They'll buy them in for resale at a cost of $30. They'll need to establish an initial stock and a continued policy of 45 days stock on hand, comparing with the sale. They'll sell on credit, and on average, it'll take 50 days for the customer to pay. I mentioned the supplier terms. We need to buy the initial stock and then 40 days, or 45 days it should be, actually. My slides get there. And they're going to sell 200 units a month. So what's the effect of that on the profit, on the balance sheet, and on the cash flow? So that is the typical
great question.
Question that an advisory firm could be asked to supply.
Yeah.
So what I'm showing here is the individual tool. And by the way, I don't have to tell you this yet again. If you're going to do a budget, you're going to reach for Excel. No, you're not. Hiding to nowhere are Excel budgets. 90% of them have got errors in them that authors don't know about, and I'm not just quoting that. That's international research. And it takes you 10 times as long to do a set of budgets in Excel as it will in a purpose-built tool like PlanGuru. So you can see here, I've done some calculations. I've said there are the sales units, 200 units a month. There's the selling price, $50. There's the cost price. So what's our predicted revenue? It's $10,000 a month. What's our predicted cost? It's $6,000 a month. And then let's link that into the income statement, where we've got the sales and cost of sales and the gross profit. Now, obviously, you'd have operating expenses and what have you, but for the purposes of this example, there is key drivers for the sales and cost. Number of units, selling price, and cost price. So, but what's the effect on the balance sheet? If we come over here and have a look at accounts receivable, for example, there's the 50 days that I mentioned. So 50 days, average days to collect, obviously that has a significant impact on the cash flow. What about the inventory? Well, we need to establish that on day one and then maintain 45 days average holding. Down here in accounts payable, this is our supplier terms, 40 days. So as we replace the stock, we've got 40 days to pay. So you've got both sides of the equation. But what's the cash flow? Let's have a look at the cash flow. So here in internationally accepted format, this is called the direct method of cash flow, starting from revenues, and it works through and says, what's the effect on operating activity? Well, the first month, it's negative 9,000 because we've had to buy that stock. So we've got a cash requirement, if you like, of 9,000 in month one, an additional 733 in month two, and 4,400 positive in month three. And obviously this translates down to ending cash in the balance sheet. So if I have a look again at the balance sheet, you'll see that cash and cash equivalents. So we'd have to find a bank overdraft, for example, of 9,000 or nearly 10 actually, to fund that particular set of widgets, proposition the clients close. So that's what it's all about. Now that little file in Panguru took me 15 minutes to put together.
Right.
So when a client rings up and says, here's the deal, here's the widgets, here's the quantities, what's the effect? How much money are we going to need and will it be positive? Sure, it'll be positive. At the end of the year, $30,000 profit in cash. The actual profit was 48,000, but because of debtors, creditors and stock, etc., that doesn't translate to cash. And that's the important issue. Predictive accounting says three-way: profit and loss, balance sheet, cash flow. So, Peter, that's the little example. I think that illustrates what we've both been talking about, are those key drivers.
Yes, it does, Paul. And, I think it's very important that accountants are very much aware of this process. We all understand this, but we need to make sure that clients understand it, because I think after the horror year that most businesses had last year, there's going to be some re-gearing up going on by businesses. And there's some loan funds on offer at present, but the federal government special loan fund expires on the 30th of June. And so perhaps accountants should be sitting down and talking to their clients and making sure that they're going to have enough cash flow to carry them through as they re-gear up their businesses, because a lot of them would have run right down, wouldn't they? And they mightn't have much money owed to them by debtors because they weren't making sales at the end of last year, and they might have run down their inventories. Now, as they start to rebuild, you get the same result as what you've got in that very small exercise, and that is businesses who start building up their inventory, it costs cash. They start building up their debtors because it's only what they can sell, it costs them cash. And sometimes, of course, you and I know, you find a situation where businesses are showing a profit in the profit and loss account, but they haven't got any money. They've run out because it's tied up in inventory or in debtors, or maybe in capital expenditure, or maybe a research and development project. So it's really highlighting that this exercise, I think, predictive accounting, needs to be done with the leadership team and the business, especially this setting of the key driver parameters. And the accountant needs to have thought this through first and have gone through everything that's likely to happen in this business. Their expansion, so that's making sure there's a capital expenditure budget. If they're undertaking research and development, which is a different activity, they've hired some different staff or they've got different expenses, what's the outlays going to be? What's the plan? How long is it going to take? If they're getting involved in registering patents, all these things cost money and invariably slow down income being earned. Rather than the accountant just going off and doing this exercise on their own. So what would you think of that? That they should be working with the leadership team?
Absolutely. And they should put themselves in a position of as if they were CFO on the payroll.
Yeah.
So they should be saying to the CEO, what are we doing about our budgets? What are we doing about our forecasts? What are the key drivers? Right now, it's very timely. You mentioned loans and what have you, Peter, but what about JobKeeper finishing?
Yeah, it finishes this month, doesn't it?
What better time to reforecast based on that assistance no longer available? I know that there are many businesses out there that have only been profitable by that JobKeeper assistance.
Yep.
So how are they going to translate that once that assistance stops? And again, you can't do that on the back of an envelope.
Yeah, that's why I was referring to those special federal government loans that the banks have got access to, because that's 50% guaranteed by the federal government if the business meets the desired criterias. But that runs out at the 30th of June. Now, if your client's got the right assets, they can still borrow in the traditional manner, and but some of them won't, and that's one of the advantages the federal government's loan offer, as I see it. They were accepting that some businesses are not going to fit into the strict requirements that banks normally require, and it's no use talking about all this in mid-June, is it? It's with that loan offer expiring at the 30th of June. This planning needs to be done now. And obviously a bomb's about to go off with the end of JobKeeper in what? About 28 days time when we're recording this.
That's right. Yep. Yeah, so I guess my advice for practicing accountants and advisors, if you're not currently using a predictive accounting service as part of your virtual CFO approach, then leap in and do it now, because otherwise you're going to get left behind. And I can foresee a situation where there is a competitive market for advisors. It's nowhere near competitive now. But going back to my comment saying, let's make predictive accounting compulsory, the client that says, but I don't want to do that, why don't you want to do it? Because I don't think I'll get value. Well, you can do one of two things. You can say, well, maybe I don't want to work with that client. I'd rather work with a client that does see the value. But what about guaranteeing that that client will get value through the review meetings and questioning those key drivers and a continuing relationship, and give him his money back if he for any reason doesn't think so?
Yes, can be done. And it's part of the challenges confronting accountants, isn't it? And the other issue you were raising there reminded me of an item that I wanted to bring up, and that is your comment about the need then to review each month or each quarter at the most how the business has actually performed against budget, because the Plan Guru system allows for fine-tuning of the budgets, doesn't it? If things change, we're not stuck with the original. We can still have and should have the original budget and cash flow forecast, but you can get updates to reflect current changes in conditions.
Absolutely. Plan Guru talks, inverted commas, to a number of accounting systems, Xero, MyOb, for example, QuickBooks Online. So you must compare the actuals with that original budget. And while it's important that an original budget be maintained and filed away on the shelf, as it were, you've got to be able to do a rolling forecast. And that's the other thing that I really recommend to accountants out there. Make sure you're doing that rolling forecast, which is a continued update. And it might go back to those drivers. If my friend who had the widgets overestimated the sales, it's very easy to update that budget going forward to reflect those changes as the actuals start to roll in. And so you can have a continued update of what that position will be. It might be that we've underestimated the funding requirement. It's still profitable, but maybe we underestimated the funding requirement. That's what the rolling forecast might show. Yeah. So budgets aren't something you do once a year. They're a tool you live with every month of the year.
Yes, and Paul, one of the other suggestions, it started with Andrew Geddes, one of our person you know well, and many of our viewers will know very well. In one of these discussions about a year ago, Andrew went into some depth on the concept of a business review meeting being conducted every month. Andrew was talking about the system that he, as the chair, in conjunction with the CEO, had introduced at Green Cross Limited. And Andrew was the chair of that public company, top 200 ASX company, actually, for 10 years. And they introduced this concept of a leadership team meeting each month. It was outside the board of directors meeting. The board of directors meeting followed a few days later. But the board knew that the leadership team had met, a lot of them by Zoom, to review the progress. So it was a report where their CFO was expected to update the financial analysis, really having dug down into various figures and activities, looking at the key performance indicators, but most importantly, reporting on where they were compared to their forecasts and what changes had to be made. I think a lot of accountants should be marking that as also something I think should be compulsory, especially in their offering of their services to their clients, that they will project manage the organisation of a business review meeting monthly, or at the very longest quarterly. And this should be not maybe, but should be one of the very key items that's going to be discussed at that review meeting. How are we going compared to our forecast?
Yeah, absolutely. Another little anecdote. I worked with a quite major company not that long ago, and was talking about that concept of the rolling forecast. And do they do that? And they said, yes, they did. And I said, that's fantastic. And does that go to your board? Yes, it does. Monthly? No. Quarterly. Why quarterly? Well, that's when our accounting system is up to date every quarter, obviously driven by BAS, etc. I said, how possibly can your board make decisions only 4 times a year on key information? You've got to give it to them monthly at the very least. Nonetheless, I did succeed there. That company proceeded to monthly reporting and changed their accounting system. It was obviously archaic and it just wasn't performing for a monthly report.
Yeah. So there's a lot of opportunities out there for accountants to be utilising predictive accounting with the traditional accounting systems, whichever the client's using, to be able to add value to the services that accountants are providing, isn't there?
Oh, absolutely. And I guess the thought I'd like to leave as we near the end of the session is, traditionally, before we had tools like Panguru, budgeting was actually quite an expensive exercise because it was very time consuming. The one time I've seen a proper Excel 3-way budget, it wasn't just an Excel book, it was 3 books and it was 156 sheets. Well, imagine the time to maintain that. And that's the good news out there. We can do this for our clients and we can do it economically. It's not going to cost them $10,000 every time we do a budget. It can be done very, very economically. In my case of the widgets, that only took me 15 minutes to get that result. So if the client rang in the morning, by lunchtime, I would have had an answer for it.
Yeah.
And you can't ask for better than that.
And we really want this whole process to be driven, with all respect to bank managers, but driven by the business needing that information to help them make better decisions, and they automatically pass it on to the bank without the bank even having to ask for it.
Absolutely
and
right.
I think that will improve the client's relationship with their bank in any case. So Paul, thanks very much for your time today and sharing your thoughts, and obviously this overview of predictive accounting and what Panguru software can achieve. We'll be having a further discussion on predictive accounting in a special presentation you and I are going to make on the 14th of April. That's a Wednesday also. And that will be at 12 noon AEST. We're beyond daylight saving by then.
Yes.
So we don't have to worry quite as much. Obviously, the people in South Australia and Western Australia and Northern Territory still do, but we'll all be back into the one zone. Next week, we continue with this series of special conversations on issues related to the delivery of business advisory services for accountants. My guest next week is Priscilla B. Smith from Brisbane. Priscilla is a practicing accountant, but also gets involved in the delivery of training packages to assist people to become licensed with the various authorities relative to preparation of business activity statements, getting their income tax tax return licenses, etc. But we're going to talk about what services should accountants, bookkeepers, and business advisors be looking to supply to their clients now at this stage in 2001. Obviously, Paul, you and I have discussed a very important component of that today, but there are a lot of other issues and we'll be going through them next Wednesday. So Paul, once again, thank you very much for your time, and everyone that's watching us, thank you. If you do have any questions, and I hope you do you agree that predictive accounting should be compulsory? I'd really like to, Paul and I do, but if you disagree, please send us an email, peter@essbiztools.com.au, or you can go to our website, www.essbiztools.com.au. Paul, if they want to contact you, if you want to give your email address. Or...
No problem. Paul@beyondaccountingtechnologies.com or paul@planguru.com. Either will find me.
Okay, so thank you. Thank you very much, Paul, and thank you everyone for watching. Have a great day. Goodbye.
Thanks, Peter.
Bye.